RSI says, yes, Oliver, but the 20-period moving average is different on all time frames. Yes, it is. But miraculously, you'll see that it has the same reliability no matter where you go, what time frame you look at. So why don't we just take a look at that? Let me show you that. All right, I'm going to show you this just so that it's not just theoretical, right? Here, this is a daily chart. Now you see that 200 period moving average there. That red line is the 200 period moving average. The blue moving average is the 20 period moving average. Look how reliably, right? We're going to have a pullback because it had rallied very decently off of its pivot low here. It ran right into the 200. It's rare if something goes straight through that as if it's not there. This is we're gonna pull back a bit. Now that's on the daily time frame. Now if you go to, here's the 15-minute time frame. Look at how it does basically the same thing. From here, rallies to the 200 and then drops back. All right, even this starts obeying the 20-period moving average. Boom. I just changed the time frame and the moving averages are practically have the same reliability. Here's a 5-minute chart. What my traders will know here is that, listen guys, the market is a breathing mechanism, right? So what it does, it starts off from a narrow state and goes to a wide state. From a wide state, it goes back to a narrow state and repeats. From wide back to narrow, repeat. Wide, look at the moving averages, wide, back to narrow. Now we're going wide again. And from there, wide, we'll go back to narrow, repeat, repeat, repeat. And if you know my method of trading, you'll know I teach you to get into the market during its narrow states. And we ride the wide, right? We want this part of the cycle. You want this part. Oh, that's this part right here. This part of the cycle. You basically want that move right there. Boom. It's coming out of a narrow state. The moving averages are together, both of them. You'll be very impressed to see that no matter where you go, what time frame, the same two moving averages have the same reliability. My tactics and techniques and strategies I teach you, some of which I share here on the channel, they're applicable in every time frame, and you'll be amazed at how reliable they are. Can you use the 50 only to help you in trades? If you undersells over the 50 buy, well, it's not that simple, but I would rather you use the 20-period moving average versus the 50-period moving average, right, for those purposes. The reason is because if a stock is flirting with its 50-period moving average, it's a weak stock, right? Because in order to get to the 50, a stock has to break through the 20. If you use the 20-period moving average as your main moving average to judge momentum and velocity, and you require stocks to be above their 20-period moving average, you're going to grab the strongest of the strongest. But if you just require them to be above the 50, you're going to grab a bunch of weak stocks too. Strong stocks don't greatly violate their 20-period moving average. And the rules with this, the 20 is very simple. 95% of the time, you should be trading in the direction of the 20. If the 20 is pointing up, you're a buyer on pullbacks. If the 20 is trending down, you're a seller. But you see when the 20-period moving average is declining here? All right, see that declining 20 right there? I want, during a declining 20, you want to trade the stock in the direction of the 20 in this case. In this case, it's rising. Here, the 20-period moving average is rising. What are you doing when it's rising? You're buying above red. You're buying above red on pullbacks. And you're taking profits away from the 20. You see? Away from the 20. and you're trying to go in a little closer to the 20. Get out away, get out away. So the 20 is used for a lot of things. It's used for profit taking when your stock is far away from the 20. Profit taking when the stock is near a rising 20. Look for a color change. And it's a directional guide. I took losses across my firm, all losses, okay, over a 6-month period. All the traders' losses. And we looked at them. 86% of the losses were trades against the 20-period moving average. So meaning that if the 20-period moving average is rising, this losing trade was a short. It was shorting against a rising 20-period moving. 86%. That's huge. The majority of your losing trades, I promise you, they break that rule. That you're buying and the 20-period moving average is declining. You're selling and the 20-period moving average is rising. I guarantee you that's more than 2/3 of your problem if you're consistently losing right now. The other part is position. I won't talk about that now, but my traders know this too. If I can get direction right with you and position right, now it's just let's keep our losses under control and let the numbers fall where they may. Argus saying, have a hard time seeing the Fab 4 tight or wide. Sometimes I see them tight and they're $2. And your question is sometimes tight looks like it's $2, a $2 fabulous 4 zone. And sometimes it's 30 cents. It's relative to the stock, right? There's no number for a narrow Fab 4. A narrow Fab 4 for Apple is going to be different than a narrow Fab 4 for some stock that's trading at $14. But it's narrow to itself. It is not narrow in comparison to another stock. So you can't look at it like that. Is this narrow based on Apple's history? You've got to become intimate with what you trade. This trading something that you're not familiar with is really the most novice move. Professionals don't trade what they don't know. They're so intimate with what they trade that it's almost like the stock is their child. You know when your child's lying, when your child's sad, when your child is happy. If you're intimate with your stock, you'll know when it's in a narrow state. You'll know when it's in a wide state. These are fairly basic things, but it's relative to itself, not to another stock. Please keep that in mind. What I teach my traders is universal in its application. The tactics and the techniques that I teach my traders can be universally applied across all financial assets, meaning it doesn't matter whether you're trading the dollar, a currency, a forex pair, whether you're trading an options contract, whether you're trading in equity, whether you're trading a cryptocurrency, it doesn't matter. All right. My tactics are based on basically the psychological shifts between fear and greed in the markets. These shifts between fear and greed in the markets, they exist in all markets. And that's what makes it universal. Not only are the tactics and techniques universal across all markets, it's universal across all time frames. So my tactics, if you apply my tactics and techniques to a 1-minute chart, it'll work there. If you apply it to a yearly chart, it'll work there. Weekly, it'll work there. Daily, hourly, 5-minute, 2-minute, it doesn't matter. Because, again, all my tactics are designed to do is to teach you how to find that shift. When does fear stop in the market and pass the baton back to greed? That moment where fear was running with the baton, fear, all right, and fear passes the baton to greed, and greed takes off. But there's a moment where both fear and greed have their hand on the baton. There's that split moment. Now, what does that moment of transfer look like? What if I told you there's 7 pictures of that moment? And all you got to do is learn the 7 pictures. There's 7 ways greed passes the baton. 7 pictures. And there's 7 ways greed passes the baton back to fear, and there are 7 ways fear passes the baton back to greed. And if you understand these 7 signs that a shift has occurred, all the game is now is just weeding out those that don't work from those that work. Anytime one of those seven things occur in your stock or the item you're trading, boom, protect yourself. Wipe out those that go in the opposite direction. Get rid of those and let the others flourish. That's all trading becomes. Once you know what to act on, everything is trade management. Everything is risk management after that. Now, sadly, most people don't ever get to a place where they know what to do. They know when to act. They don't have that. But once you know I act on these 7 things, now everything is trade management after that.